In this lecture, we'll talk about direct price discrimination. In the absence of price discrimination, a firm setting a single uniform price on its product faces a fundamental pricing trade-off. They can set their price low and sell more units, increase quantity, but earn less on each product, or they can set the price at a higher level, selling fewer units but earning more on each unit sold. Marginal analysis tells us how to balance this trade-off or tension in the case of a single product selling at a single price. And we set marginal revenue equal to marginal cost, which is equivalent to setting the price so that the actual margin is equal to the optimal or profit maximizing margin. Price discrimination allows sellers to avoid this trade-off. They can set higher prices for some customers and lower prices for others. Let's take a simple example. Suppose a firm is facing a very simple demand curve, and we've got 7 customers in the market. And these 7 customers have values or top dollars that they're willing to pay for the particular product of $7, $6, $5, $4, and $3. The marginal cost of this particular good is $1.50. And it's very straightforward to show that if the firm sets a single price for this particular product, the optimal or profit maximizing price is $5. To see this, let's consider these numbers. We can create a very simple demand schedule from $7 down to $1, and we know that if the price is set at $7, one customer will purchase this particular good. At $6, we would have 2 customers. At $5, 3. At $4, 4 customers would purchase the good. At $3, we would have 5, and so on. We can calculate the total revenue, which is equal to price times quantity, and that would be $7, 12, 15, 16, 15, 12, and 7. Now, we can see that revenue is maximized at 4 units sold at a price of $4, but it's not necessarily revenue that we want to maximize, it's profitability. And to find the profit maximizing single price, we can apply marginal analysis and identify the point at which marginal revenue equals marginal cost, or at least the point at which the two are closest. We're dealing with discrete whole dollar prices, so only by coincidence will these marginal revenues and costs line up exactly at the whole dollar intervals. Let's first calculate the marginal revenue, defined as the incremental revenue generated from one additional unit sold. The marginal revenue of the second unit sold is 12 minus 7, or $5. The marginal revenue of the third unit is 15 minus 12, or 3, and so on. We can identify the marginal revenue. It actually becomes negative as the total revenue goes down when we move beyond 4 units sold. The marginal cost we were told on the previous slide is $1.50, and that is the case for each unit. We can see that the optimal level of sales is actually 3 units sold at a price of $5. That is the last point at which marginal revenue exceeds the marginal cost. Below the line I've drawn, the marginal revenue is less than the marginal cost, and each additional sale below the line brings in less revenue than it costs to generate that sale, and therefore the profit declines. We can calculate the profit as being equal to the quantity times price minus marginal cost. With 3 units sold at $5, we're bringing in $15 of revenue and generating costs of 3 times $1.50, or $4.50. The total profit at this level is $10.50. Each unit generates a total profit of 5 minus 150, or $3.50. So another way to look at this is each of the 3 units generates $3.50 of profit for the total profit of $10.50. Now, this is the optimal single price, but the idea behind price discrimination begins with the following observation. A firm that sets a price of $5 and sells 3 units is, in some sense, leaving money on the table. Why do I say they're leaving money on the table? Well, look below the line. We've got 4 customers with different values. This customer is willing to pay $4. This one's willing to pay $3 and $2 and $1. This product costs $1.50 to produce. So below the line, we have at least 3 customers who are willing to pay more for this product than it costs to produce that product, and yet we're not selling to them. Now, the reason we're not selling to them at a single price makes economic sense. The reason we're not selling is because if we drop the price from 5 to 4, we do generate one additional sale, but we sell the product at a lower price, not only to the 4th customer, but to the 3 customers above the line who were previously willing to pay $5. So price discrimination starts with this observation and then asks, what could we do in order to make additional sales and additional profits to some of those individuals below the line who are actually willing to pay more than the marginal cost of this product? Direct price discrimination answers that question for the situation where the firm can positively identify which group, the high value group above the line or the low value group below the line, which group a customer belongs to. Let's make an assumption. Let's suppose that we're dealing here with the prices of admission to a movie. And let's suppose that all of the individuals below the line are either senior citizens or students, both of whom carry IDs and both of whose membership in the low value group can be positively identified. If we make that assumption, let's just assume that these are students who have a student ID, then the firm could set a different price for the students than they do for regular admission. What price would they set? Well, we can answer that by simply identifying or analyzing this subgroup separately. So let's look at this submarket of students and ask the following question. At prices of 4, 3, 2, and 1, how many tickets would be sold to the students? Well, at a price of $4, we would have one of these students willing to pay admission. At a price of $3, a second student would be willing to pay. At a price of $2, we would have 3 students, and at a price of $1, all 4 students would be willing to buy the ticket. What's the total revenue generated? 4 times 1 is $4 for one ticket at $4, 6, 6, and 4. The marginal revenue we can also calculate. The marginal revenue would be 4, 2, 0, and -2. We know the marginal cost. The marginal cost is unchanged. That hasn't changed. It's still $1.50. And what we see here is that among the students, there's actually another break point that occurs at a price of $3. If we set the price for students at $3 or equivalently offer a $2 discount for students, that would take the price down from the regular price of $5 to $3, we see that in this case the movie theater could sell 2 additional tickets to students. They would make some additional profit because both of those tickets have marginal or incremental revenue that exceeds the marginal cost. In the case of selling 2 tickets at $3, that would generate an additional $3 of profit. $1.50 per ticket times 2 tickets. And the $1.50 comes from the difference between the price of 3 and the marginal cost of $1.50. So here it happens coincidentally that the marginal cost is $1.50 and the profit per ticket sale is also $1.50. Now, price discrimination in this case offers the firm an alternative to setting a single uniform price if they can positively identify the individuals in the low value group and they can find a way to prevent arbitrage. In this case, that would mean preventing the students from buying the tickets at $3 and then turning around and selling them to moviegoers who approached the theater at, say, a price of $4 or $5. One way to do that would, of course, be to ask for an ID when the ticket was presented for admission. So, to summarize what we've seen here in this numerical example, at a price of $5, the low-value customers, those who would pay $4, $3, $2, or $1, did not purchase the ticket and were shut out of the market, even though they had values, or at least 3 of them had values, above the marginal cost. And so it leaves some unconsummated wealth-creating transactions begging for consummation. So price discrimination is the strategy that allows for that. And in this case, if the individual or if the movie theater or the firm sets a second price for students in the low value group of $3, they'll sell 2 additional units. They increase their profitability and more customers benefit from being served. So the motivation behind price discrimination is that it allows a firm to sell items to low-value customers who otherwise would not purchase them because the price is too high. So the firm consummates additional wealth-creating transactions. If price discrimination is the practice of charging different prices that are not cost justified, then what that means is that the ratio of the price to marginal cost among the different groups of customers will not be equal. Instead, the prices are going to be set optimally for each group. We could take the single pricing strategy or the profit maximizing strategy that says set price so that the actual margin equals the optimal margin, being equal to 1 over the elasticity of demand. But now what changes is we have 2 different groups. Each group has a different price sensitivity. We've got the high value customers with less price sensitivity and a lower demand elasticity. They're going to be charged one price, and that price will be higher, and the margin associated with those less price sensitive individuals will be higher as well. The very price sensitive customers will be charged a lower price that maximizes the profitability within the low value group, and that price will be set so that the margins among the low value customers are equal to 1 over their price elasticity of demand. If their price elasticity is higher, they're more price sensitive in the low value group, then 1 over E will be smaller, and the margin among the low value customers will intuitively be smaller as well. The bigger the difference between the 2 groups' elasticities, in other words, the bigger the gap between their price sensitivities, the more profit opportunity there will be in a price discrimination strategy. To price discriminate in a direct manner, the firm has to be able to identify the different groups with different elasticities of demand or different values, and then find a way to prevent arbitrage between those 2 groups. Indirect price discrimination refers to a situation that occurs, or a type of price discrimination that can be pursued when a firm cannot identify the members of the group or perhaps cannot prevent arbitrage. In that case, indirect price discrimination involves discriminating by offering 2 different products that are designed specifically to appeal separately to the high value and low value customers. The idea behind price discrimination, indirect price discrimination, is that if the products are well designed or appropriately designed, they will effectively induce the high and the low value customers to self-select. The high value customers will be naturally drawn to and purchase the high value product. The low value customers will be naturally attracted to and purchase the low value product. In a different lecture, we'll talk more about indirect price discrimination, which involves not only pricing decisions, but also product design decisions as well. Let's take a look at a couple of examples. How about tickets to a movie theater? Discounts like senior citizen discounts or student discounts. We've already seen that those are examples of direct price discrimination because the movie theater could identify whether an individual belonged to that particular group. Grocery stores often offer coupons to their shoppers. Could be in-store coupons, could be weekly mailings. This would be an example of indirect price discrimination because people reveal their presence or their preference or membership to a certain group by their actions, by whether they clip coupons and present them or not. Airlines offer business class and economy class tickets and develop pricing strategies to target those 2 different groups. Again, this is an example of indirect price discrimination. An airline cannot positively identify whether an individual is traveling on business or leisure, but buyers reveal their preferences and buyers reveal their membership to one group or another by certain actions and choices that they make. Price discrimination opportunities abound anywhere we have differences in price sensitivity or differences in value among customers, which is just about everywhere. I'd encourage you to think about opportunities for price discrimination at your own company and see whether you could take this material and apply it to the products, the goods, or the services that you sell. Now, a couple of legal issues that are important. The Robinson-Patman Act in the United States prohibits providing price discounts on a good sold business to business to another business. The idea behind the Robinson-Patman Act was that it was designed to protect independent retailers from competition from chain stores and to prevent the chains from receiving supplier discounts. Ways to either get around or conform to the requirements of the Robinson-Patman law or to defend against a Robinson-Patman lawsuit would be to argue that the price discount from a business to a business was cost justified. Certainly a cost-based pricing strategy can incorporate differences in cost and translate those into differences in prices. Or that the price discount was given to meet the competition. Europe has similar, although even stronger laws. And promotional allowances that are offered or vertical integration within a firm are two other ways to avoid liability under the Robinson-Patman law. Let's look at an example of computer pricing. Computer companies often sell a wide variety of their products to a wide variety of users with a wide variety of price sensitivities. Computer companies then identify the price sensitivity by either having the customer self-select or identify themselves through their purchasing. To identify the price sensitivity of online customers, Dell Computer has different categories in which users can shop, such as home and home office, small and medium business, large business, etc. Under the small and medium business category, a laptop was listed for a price of $1,197. Under the large business category, the same computer was $1,339, a 12% increase. This pricing scheme allows Dell to sell the identical computer at different prices based on differences in consumers' price sensitivity. I want to thank you for listening to this lecture on direct price discrimination.